Good day everyone, my name is Tamer, and in today's video we will cover an important topic, and it's the market's valuation, and I'll give you a brief update on one of my investments that I made during the 2020 crash. So let's begin with a brief review about the markets, and then we will talk about the investment that I made. Okay, so back in February 19, the major indexes in the US started tumbling, and that was because of the whole coronavirus. Markets fell down rapidly and ended up crashing 37% in a matter of a month or so. Behind the scenes, things were getting really ugly. Credit market froze up, liquidity dried up, and that's because everyone was deleveraging, and that's when the Fed came into the picture. In a world where everyone is deleveraging, the Fed stood up and said, "I'll be your buyer." To understand how aggressive the Fed was, check this out. Between March 16th and April 16th, the Fed bought treasury and mortgage securities at a pace of nearly $79 billion a day. By comparison, it bought about $85 billion a month between 2012 and 2014. Doing those things, the Fed basically said to everyone, "We got your back at any cost." The market on March 23rd started climbing, and since then, the S&P 500 is up 42%. And we are down only 5% since February 19th. Now let's see if the market is overvalued, and we're going to do that looking at two metrics. So the first one is the Shiller PE ratio, and the second one is the stock market capitalization-to-GDP ratio. Okay, so first of all, let's talk about the Shiller PE ratio. The Shiller PE ratio is one of the most important ratios to look at when you try to figure out if the market is overvalued. Basically, it is the price of the S&P 500 divided by the moving average of 10 years of earnings adjusted for inflation. And let's see why it's important. The regular PE ratio uses the ratio of the S&P 500 index over the trailing 12-month earnings of the S&P 500 companies. During economic expansions, companies have high profit margins and earnings. The PE ratio then becomes artificially low due to higher earnings. During recessions, profit margins are low and earnings are low. Then the regular PE ratio becomes higher. So it means that in recessions, the PE ratio, the normal one, the traditional one, actually sends you selling signals. Okay, it sends you a selling signal saying that the PE ratio is high, the returns are not attractive, sell everything you have. But during economic expansion, it shows you that the PE ratio is lower, meaning that it's giving you a buying signal. And if one thing that we learned throughout history is that when the market is during its peak, when we are at the last inning of the economic expansion, then you should be more defensive and less aggressive. And the traditional PE actually shows you the exact opposite. And that's why we are focusing on the Shiller PE ratio and not at the traditional PE ratio. So currently the Shiller PE ratio is trading at 30. One of the highest since 1880. Around 1929, the ratio was at 30, and back in 1999, the dot-com bubble, it was at 44. So to put things into context, the minimum read was 4.78, and it was back in 1920. And if you remember, in 1920, what followed that year was the Roaring 20s. We had one of the greatest runs in the history of the financial markets. And that, of course, was followed by what? That was followed by the Great Depression. So if we take a look at this ratio alone, the Shiller PE ratio, the S&P currently is overpriced. And the returns for the overall market will not be good if we take a look, of course, at the historical figures and try to compare it with what we have right now. So right now, let's talk about something called stock market capitalization-to-GDP ratio. By the way, this ratio is Warren Buffett's favorite ratio. He looks at it, sometimes it's even called the Warren Buffett ratio. And just to make it simple, it's actually the stock market capitalization divided by the GDP, which is the gross domestic product, and then multiplied by 100. So as of today, the total market index is at around $30 trillion, which is about 150% of the last reported GDP. So if we take a look at historical averages too over here, and we try to figure out if the market is overvalued or undervalued, and if we take a look at the reads, so if the ratio is below 50%, it means that the market is significantly undervalued. If the ratio falls between 50 to 75%, it means that we are in a modestly undervalued environment. If the ratio falls between 75% to 90%, that means that the market is fairly valued. And if we start going between 90% to 115%, that means that the market is modestly overvalued. And if we hit a higher point than 115, that means that the market is significantly overvalued. So as of today, the ratio is currently at about 150%, which means that the market is also, according to that measure, is significantly overvalued. So if we take a look at those two things, we can see that the market is overvalued. Also, if we take a look at how people are acting in the market right now, if we take a look at really bad companies and how they're achieving huge returns in the market, we can see that the market is actually kind of being irrational right now, which is, I think, everyone can agree on. And with that being said, now I'm going to give you a brief update on my portfolio and one of my investments. So back in March 18th, I have released a video talking about two companies. The first one is Alphabet and the second one is Ollie's Bargain Outlet. After releasing that video, I have decided to buy Ollie and to pass on Google. My reason was that the company has more room to grow, and better yet, it operates in a slow growing industry. And the company is a fast grower. So since the video was released, the shares have jumped more than 150%. I didn't catch the whole rally, but I managed to get a bagger out of this investment. So the question that I'm asking myself right now, should I sell my position or should I trim it or whatever? In my opinion, the price might be getting a bit extended over here. The whole market is overvalued, in my opinion, as I just said. And it doesn't mean that the market will start falling though. But since my portfolio is not big, I would like to be on a safe side and have liquidity. So I already took some profits out of Ollie. I still have shares in Ollie and I'm also invested in the market, of course, but I'm kind of being more defensive right now, or let's call it more cautious, because just looking at the history, looking at the ratios, looking at some behaviors, you can tell that the market is getting ahead of itself, let's call it. But with that being said, let's wrap the video up. Thank you for watching, and if you haven't followed my Instagram yet, go do it right now because there I upload daily. Have a great day and see you in the next video.